Yesterday, I tweeted, "Stay humble, stack sats," in an homage to Matt Odell and all of the Bitcoiners who have known for the past decade that if you're going to arrive early to a revolutionary technology that's and the first digital commodity that's monetized in the history of the world, you're going to be in for a bumpy ride. So Bitcoin has been a continually bumpy ride for the past, many years. I think even since we got in the market, it's gone through nearly 3 cycles. And the only rational way to approach this is dollar cost averaging. So MicroStrategy is in essence just dollar cost averaging into Bitcoin. Our strategy is we acquire Bitcoin, we hold Bitcoin, and we just happen to believe that 100 years from now, Bitcoin is like Manhattan, and you're just going to want to hold as many blocks of Bitcoin as you can. If you acquired Manhattan in 1907 and 1913 and 1917 and 1921 and 1928, 1932 and 1947, and then another thing in 1953 and 57, and you asked someone, what was the right time to buy, and do you regret having bought, the top? I can't even remember which of those years were going to be the most efficient times to buy. Generally, the view is that once you find a good thing, you just want to consistently acquire more as cash flows allow you. So our strategy is simple, right? We acquire Bitcoin, we hold Bitcoin, we don't sell Bitcoin. Right? The only mistake you can make is acquire it with so much leverage that you get forced liquidated on a drawdown. And that's a mistake. You don't want to get stopped out. And then the other mistake is to stop acquiring, right? And in this particular case, if I look at all the options, there's no better option. Bitcoin is the least risky strategy that we can find. If we're acquiring real estate in Africa or Asia or South America, what could go wrong there? If we bought stocks, there are plenty of stocks that are down 80%. And if you bought something that, that's on the wrong side of some government policy, then that can work against you. And, if we just kept buying gold, it's just going nowhere one way or the other. So I think that what you're seeing is MicroStrategy just dollar cost averaging as a public company, and you'll continue to see us do it because we generate cash flows and we're profitable, and this is by far the most rational thing we can do.
Yeah, absolutely. And keeping it in cash would make you basically lose like 20-30% per year, potentially in the future even more. A topic I wanted to touch later on as well, as we see Turkey with crazy inflation rates and so on. First of all, I wanted to talk about something else. I see a lot of rumors, comments popping up on Twitter and everywhere about the liquidation price that MicroStrategy, Michael Saylor are going to be liquidated. As far as I know, just a small portion was bought on margin, right? Or was bought on leverage. Is there some liquidation price? At what price would you get sweaty hands? As we all know, your hands are not sweaty at all right now.
Yeah, I think the key to keep in mind is when we had about $4 billion, almost $4.5 billion of unpledged Bitcoin, we borrowed 200 million and we agreed to pledge Bitcoin as collateral. So we entered into a loan, which was a loan to value of 4%. And when Bitcoin was cut in half, we're still 10x over collateralized against that. So in essence, this is kind of like having $1 million of collateral and borrowing $40,000, right, against it. If Bitcoin goes down by 95%, then you would have to pledge some additional collateral. But when we did it, we also have other cash and cash flows, and we have other assets. So we were actually prepared for the worst case. In our case, if you do the math against our Bitcoin position, when Bitcoin gets to 3,500 or so in Bitcoin, we have to come up with some other collateral if it keeps going lower.
And that is, I think, even one of the biggest bears. If not, Peter Schiff will say that is not likely. Maybe for better explanation for people watching here, if you are familiar with leverage trading, a 20x leverage trade is when you have 5,000 in and you borrow 20x that amount. But if you have $5,000 and you borrow like 5% of that, that's a 1.05x leverage. And that is extremely unrisky. That is something people have to understand here, of course. I want to talk about something else. In your answer to my first questions, you talked about the cycles, and there are different theories about cycles, lengthening cycle theory, the 4-year cycle theory, which is pegged to the halvings, which are occurring almost every 4 years. Do you have some theory you want to put more belief in, or what do you think are the actual cycles behind? Of course, we can't say it's exactly 4 years, but do you think we are in a 4-year cycle? And in this case, in 2 years approximately, we have the next halving. So towards that event, we should go higher. Of course, no price predictions, but I'm very interested in your view on the cycle theories.
Yeah, well, when I think about the way that the price changes, I think there's the demand side and there's the supply side. So if I was building a model, it would be a multi-dimensional, multivariate, nonlinear dynamic model. It wouldn't be a single variable linear model. It wouldn't even be a single variable dynamic model. So I think it's indisputable that the halvings have an impact. That is, when you cut the block rewards in half every 4 years, that has a positive impact on the price because that cuts the supply that's being sold in the open market by the miners or the supply that's out there. So I think that's one element. But my model for the price of Bitcoin is, it's a function of adoption, and it's a function of technology utility, and it's a function of inflation. All three of those. And then it's presumably a function of time, especially in the sense that over time, the supply hardens, right? And Bitcoin mining supply decreases because of the halvings. So all of those are important variables. When the technology improves, like when we're building Bitcoin into a Cash App, if you build Bitcoin into Cash App and then you build Lightning into Cash App, and if I can send you $5 of Bitcoin for free in a split second, then the utility of Bitcoin is much higher. And as Lightning rolls out to all of these application protocols, as companies like Kraken, when the exchanges build Lightning, and when the wallets build Lightning, and when there are other applications with Lightning, the utility leaps, the cost, the friction decreases. There'll be a day when billions of people will have the ability to receive and to send Bitcoin on their mobile phones instantly for free, no friction, easy. Yeah. So that makes a difference. But that technology, that drives adoption. Okay, so in a world where you have 100 million Bitcoin users using Bitcoin as their treasury asset, then you've got a certain demand. Now, if they decide they want to go all in and they want it to be 50 or 75 or 90% of their savings, adoption increases. When you go from 100 million to 500 million people using it, adoption increases. And adoption increases because of awareness. It's spreading over time. It increases because of crisis. For example, the Russian sanctions and the war in Ukraine, that drove adoption. Macroeconomic crisis. COVID drove adoption. MicroStrategy never would have bought any Bitcoin if it were not for COVID and the lockdowns. So lockdowns drive adoption, pandemic drives adoption, war drives adoption, inflation drives adoption. A lot of the early Bitcoiners, they bought Bitcoin because of the hyperinflation in Argentina. Now, so if you didn't live in Argentina, you didn't get struck by that, but all of those macroeconomic crises drive adoption. But so there's good adoption. Technology is easy. Netflix is fun. I like watching it on my iPad. That's the good, easy, fun adoption. And then there's the painful adoption. Like in Zimbabwe, the currency's collapsed and they've announced they're going to dollarize.